Welcome students. In this video, we will learn how to transfer ledger account or T account balances to the financial statements. We have two financial statements that I am talking about in this chapter. The income statement and the statement of financial position, which we have covered in detail in chapter number 15 part 1 and part 2. Okay. This in a way is extension of chapter number 3, the double entry system of bookkeeping. So you should be knowing that chapter in detail to even think about starting this topic. Okay. So make sure you have gone through that first and you understand the rules of debit and credit in detail and you know how to make T accounts. Okay, moving on. Now, we will learn in this chapter how to move the final balances of our T accounts to our financial statements, mainly the statement of financial position and the income statement. Now see this. We have asset accounts. You know about these accounts, right? These are the most common asset accounts and the list is given here. We have discussed them in detail in chapter number 3. Then we have a few liability accounts and then we have capital, in which you include the profit for the year and subtract drawings from it. These accounts are statement of financial position accounts. Okay. So they are not entirely closed. Okay, let me tell you what I mean by that. What I'm trying to say is these accounts usually have a carry forward balance. Okay, they are not closed at the end of the year. Their balances are carried forward to the next accounting year. Let's read this. In real bookkeeping, statement of financial position accounts are not closed. Okay, like income and expenses account. I will discuss that in the coming slides. The statement of financial position accounts are carried forward to the next period. Okay, let's look at one example to clarify this further. Let's move on. Let me erase this. Okay, example of an asset account, motor vehicle account. Okay, so which account are we preparing? We are preparing a motor vehicle account, and as you know, the detail or the heading of the account should come here in the middle. This side is the debit side. Again, if you are not aware of this, please go through chapter number 3 first and then come to this, because this is the this is the advanced stuff. So you should be aware of all that in order to do this. Let me just move it here. Okay. And this is the credit side of the T account. Okay. Now see, purchased a motor vehicle for $200 cash. Again, chapter number 3. You should be knowing when we purchase an asset increases in the business. So asset will be debited. So the double entry for this would be motor vehicle debit by 200. Okay, this is the debit column and this is the credit column, let's say. And then we are paying by cash. Cash is decreasing in the business. When assets decrease, we record them on the credit side. Chapter number 3. Okay, this is the double entry for that. So looking at this double entry, let me also write the date here, Jan 20. Looking at this double entry, I will have to record this motor vehicle on the debit side of the motor vehicle T account. I have told you why in chapter number 3 in detail. So I will write the date Jan 20. I will write in details the account opposite, which is cash, and then the amount involved in the transaction, which is 200. So this shows that I have purchased a motor vehicle worth $200 cash on Jan 20. These are imaginary numbers, so don't worry about them. That why is this such a small value for a motor vehicle? These are imaginary numbers. Okay, we are doing an example. Now, April 18. Purchased a motor vehicle for $1,000 cash. So let me write the date first. April. One second, let's not leave this space. I can move this up here. I can erase this and just continue from here. Okay. So April 18, the date comes here. Then I will write motor vehicle on the debit side because we are buying a motor vehicle. A motor vehicle is increasing in the business. When assets increase, we record them on the debit side. And again, we are paying by cash. Cash is also an asset. When assets decrease, we record them on credit side. So this is the double entry for the second transaction. So again, looking at this, what should I do? I will record this on the debit side of the motor vehicle account, because I have told you that wherever it is recorded in the double entry, you will also do the same thing in the T account. So if it was debit in the double entry, you will record the amount on the debit side of its T account as well. Chapter 3, okay, very important chapter. Please cover that in detail before moving on to anything else in accounting. That forms your basics, okay, and it will be used in every chapter of accounting. So 1000, okay, and I'm done. There are no other transactions. We did not buy any other motor vehicle. We did not sell any other motor vehicle. Okay, so we will balance this account now, right? So let's balance this account. You know the rules of balancing were also discussed in chapter number 3. The total of debit side is 1200. The total of credit side is 0. The total of the heavier side, one second. Okay, it's fine. Even if the line is not that straight. So see, the total of the heavier side will come under both. So I will write 1200 here and then also 1200 on the credit side, right? This side is fine. I need a missing figure on this side, which will obviously be 1200 in this case because there's nothing else on the credit side. So 1200 is my balance carried down. And when do we balance T accounts? On the last day of the year. So 31st December. Okay. So this is my balance carried down. So on 1st Jan of the next year, let's say this is 2015. So in 2016, on 1st Jan, my balance brought down would be 1200. What is this balance showing me? This balance shows me that I have motor vehicles worth $1,200 available in the business, right? So that's why asset accounts are never closed. Their balances carry forward. Because if I close this account, move this amount to the SOFP and then close this account, it will not make any sense. Assets have a value in your business, and if you still have those assets, they are available with you at the start of the next year. So they will be recorded in your books, right? This is what we show in these accounts, that we have assets worth, which means in this case we have a motor vehicle or two motor vehicles worth $1,200 combined in our business, right? We will also record this figure of motor vehicle in our non-current assets section of SOFP, motor vehicle, and then I will write the amount 1200. So I will show this in SOFP, but statement of financial position accounts are not closed. Okay, they still have a balance at the start of the next year. Okay, now on the other hand, the income statement accounts. I have told you the income statement accounts are your income accounts and your expenses accounts. Okay, these are my income statement accounts. 1 second, let me use the pen and then move it here. Okay, so the expense accounts and income accounts are usually closed and balanced to 0 at the end of the financial year. I will tell you why and how. Okay, unless there are some accruals or prepayments, which we will discuss in detail in chapter number 12. So don't worry about those now, right? But in simple words, income and expenses accounts are closed at the end of the year. Their balances are brought down to 0 and they are moved to your income statement. Okay. See, I will give you an example in the next slide for both expense accounts and income accounts, and then it will be more clear to you. But let's read this. In real bookkeeping, income and expense accounts are closed, balanced to 0 and included in the income statement at the end of the year. Okay. There is an accounting principle called the matching principle, which states that the expenses that belong to the current year should be recorded in the current year of the income statement, right? And any income belonging to the current financial year should be recorded in the income statement belonging to that year, right? So when we have recorded the expense or income in the income statement, that account's work is done. We can close that account and bring the balance down to zero, because we have recorded that in the current year's income statement and we have calculated the profit or loss. So all the working is done. So there's no need to carry forward the balance of this account unless there is an accrual or prepayment, which I will discuss in chapter number 12. Okay, in simple words, we have recorded the expense and income in the income statement and we have calculated the profit and loss of the business. So their work is done. In the next year, if we are paying for any other expense, we will open a new account and then include that in the next year's income statement, right? But in the case of statement of financial position, for example, what I showed you for motor vehicle, right? When you have a motor vehicle available with you in 2015, you will still have that motor vehicle in 2016, right? Unless you sell it. So its balance should be shown in the T account, right? Its balance is carry forward, but expense and income accounts are closed because we have recorded the amount in the income statement and we have calculated the profit and loss of the year. So their work is done. They are no longer a part of our business. That's the theory behind closing the accounts of expenses and income while carrying the balance down for accounts of assets, liabilities and capital. Okay, moving on to the example. Example of an expense account. I will make the double entries here and then move the figures to the T account. Okay. Paid $200, let's say cash, for motor vehicle repair expense. Okay. You know, expenses are always debit. Again, chapter 3, dead click. So expenses are always debited. Motor vehicle expense, repairs, debit by 200. Okay, this is debit, this is credit, and then cash, which is an asset, is decreasing, so cash credit by 200. That's the double entry for this transaction on Jan 5. Next transaction, paid 500 for motor vehicle repair expense. Okay, let's assume this is cash again. Okay. All these payments are made by cash, so no need to write. Now March 8, account to be debited comes first, which will again be motor vehicle repairs, because expenses are always debited when they are incurred, and then we are paying by cash, so cash will be credited. Okay, we can either pay by cash or bank. It's not mentioned in the transaction, so it can be cash/bank. 500 will be debited in the motor vehicle repairs and 500 will be credited from either cash or bank depending on how we are paying for that. Okay, and then October 15 we are paying for motor vehicle expenses again, motor vehicle repair. So motor vehicle repair, debit by 300, and then cash or bank depending on how we paid for it will be credited by 300. Okay, we are talking about expenses right now, so I will only prepare the expense account to show you how it is closed and balanced to zero. Okay, so let me write the name of the expense. This account is for motor vehicle expense, motor vehicle repairs, motor vehicle repairs. Okay, let me move this to the other side so that I can work on the T account. So in the first transaction, motor vehicle repairs account was debited, so I will also record this transaction on the debit side. The amount will come in the third column, which is 200, and the account opposite, which is cash/bank, I will just write cash, will be debited. Okay. Then on March 8, we again paid for motor vehicle expense by cash, and the amount was 500. And then on October 15, we are again paying for motor vehicle expense, and the payment was of $300. So what was the total amount of motor vehicle expense, motor vehicle repair expense during the year? It was 5, 6, 7, 8, 9, 10, which is $1,000. So the total motor vehicle repairs expense was $1,000, right? So how will we transfer this expense to the income statement and make the account zero? See, we will follow the same rules of balancing. Okay, so we have 1000 on the debit side and 0 on the credit side. Balance this account. This will become 1000, and then we always write the total of the heavier side under both, and then the balancing figure on this side should be 1000. Okay, what should I write in details here? And when do we balance this account? On 31st December, which is the last day of the accounting year in this case. Okay, let's assume it's from Jan 1 to December 31. Now, see, to move any expense account to the income statement, we have to make an entry for that. Okay? The entry to move any expense account to the income statement is simply, see, we have a debit balance of this account, right? The expenses were debited. So 200, 500, 300, total debit amount of this account is 1000. So to close this, we have to credit the account by 1000. So expenses at the end of the year, one second, let me fix this. Expenses at the end of the year, let me show the entry here. Expenses at the end of the year are always credited. Motor vehicle repairs. Okay. The total amount, which is 1000, will be credited. And where is this expense going? We are moving this expense to the income statement. So the account opposite will be income statement, which we also call as statement of profit and loss. Okay. You can either write income statement here or statement of profit and loss. Let me just write P and L here to show you. Okay. And then we write the amount 1000. So you see the account opposite is income statement or statement of profit and loss. So I will write income statement here. Okay. This is how we close the accounts. There is no balance carry forward. I will not carry this 1000 down here. No, because this account is closed there and then to the income statement. Okay. So remember, whenever the income statement gets debited when an account is closed, which is usually or always an expense account, whenever the income statement is debited, it means your profits will go down. Okay. So because expenses, when we close expenses account, income statement kya hogi? Income statement will get debited to close the expense account, because this was a debit balance of the expense account, 1000 on the debit side. So to close it, we have to bring a figure of 1000 on the credit side, and that figure is the income statement, because we are moving this expense to the income statement. So income statement gets debited and motor vehicle repairs gets credited by 1000. Okay. So whenever income statement is debited, it's a bad thing for the business. It means it was an expense which you have moved to the income statement. So your profits will go down because of that. Moving on to the example of an income account. Let me erase all this. Okay, example income account. See, sales is also an income. Okay, and similarly purchases are also an expense. So treat them in the same way. In the income statement, we only have expenses and incomes. Sales is an income and purchases is an expense. So it is treated the same way like we will treat expense and income accounts and move the balances to the income statement. So let's do that here. That's why I chose this example of sales to make it clear. Otherwise, you might be thinking that I'm only talking about other expenses or operational expenses. No, sales are also treated as an income, and purchases are also treated the same way as an expense. Okay, sold goods worth $500 cash. You should be knowing the transaction. If you don't know, please go through chapter number 3 first. So cash is coming into the business. When you sell goods, you receive cash. So cash will get debited by $500 and sales will get credited by $500 because sales is an income. Income जब increase होती है, we record it on the credit side. That's the transaction. On March 8, we are selling more goods and receiving cash. So again, cash debit by 700 and then sales are credited by 700. These are the double entries for this transaction. We have to make the account of sales. Okay, this is the debit side, this is the credit side. Sales was credited, so I will also record it on the credit side of the T account. The account opposite, which is cash, will come in details, and then Jan 5. And then for this for the second transaction, the date is March 8. The account opposite is cash and the amount is 700. Okay, that's it. There were only 2 transactions relating to sales in this year. Okay, so I have to balance this account on 31st December. Let's balance this. 7, 8, 9, 10, 11, 12. So this is 1200. The total of the heavier side. I hope you know this by now, how to balance accounts. 1200. Okay. This side is fine. We require a missing figure on this side, which will obviously be 1200. This figure will be balanced on December 31. Again, what will come in details? Where do we move our income and expenses account balances? We move them to the income statement. Okay, we zero the account and move the balances to our income statement. Okay, let me show you the transaction first to balance this or to move this. See, sales were credited during the year, so the credit balance of sales is 1200. Now, to make the account of sales 0, I have to debit sales by 1200, right? Because the balance of sales right now is 1200 credit, which is 500 plus 700 on the credit side of sales account. To balance this, I have to debit sales account by 1200. To balance this means to bring the balance to 0. To close this account, what do I have to do? I have to bring the balance of the debit side to 1200 as well, right? Because the credit balance of this account is 1200. So what will be the account opposite? It is always income statement for expenses and incomes. So income statement will get credited by 1200. Okay, so the account opposite in this case is your income statement, because you are moving the balance of sales to the income statement, as we have to record all the expenses and incomes of the current year to your income statement. Now the balance of this account is 0. We can forget about this because we have moved this to the income statement. When income statement gets credited, it is a good thing because your profits will increase due to this, right? So whenever income statement gets credited, it's a good thing, because when incomes are recorded to your income statement is always credited in the double entry, as you can see here. Okay. So this is how we make the balances of income and expenses account 0 and move them to the income statements. If you still need more examples, you can ask me, you can send me a message and I will help you with that, right? Now, let's read this. 1 second, let me erase all this. Okay. Why you don't balance expense income accounts monthly? See, I've told you that it's better to balance accounts at the end of every month rather than at the end of the year. But in the case of expense and income accounts, there's no need to balance them every month because they're temporary accounts, okay? They're just gathering your data. For example, I make an account for rent and then I keep recording Jan 1000, Feb 1000. You can go all the way till December 1000. So I can just balance this once at the end of the year. I know 12 months I have paid rent of 1000 every month, so the total balance will be 12,000. Then I can simply move this to the income statement and close the account by doing this, right? There's no need to balance the account every month and bring the balance down, because these are temporary accounts. You just have to move them to the income statement at the end of the year. They're just accumulating your cost in a way, right? And then they're close to zero at the end of the year. So that's it. There's no need to carry forward the balance. Even if you do that, it's fine, because at the end of the year, you anyways have to balance it with the income statement. So it will not make a difference. You will do the same thing. So it will save your time if you don't balance this monthly. And that's it for this chapter. I just told you how to balance accounts and then move the balances to these statements. Okay, SOFP accounts, which are your assets, your liabilities, and your capital account, is not close to zero. Okay, they are not closed to zero. They have a balance left over. They do have balance carry forward or carried down, because, for example, let's talk about an asset. Let's talk about motor vehicle like we did in this question. So if your motor vehicle's worth 12,000 in 2015 and you don't sell any or buy any other motor vehicle, you will still have motor vehicles worth 12,000 in the business at 2016, right? There is a balance carry forward. This balance will carry forward to the next year as well. Okay, but in the case of income statement accounts, okay, we have only two accounts that are part of income statement: the income accounts and the expenses accounts. So in this case, we are moving the entire expense, such as rent expense. Okay, let's say it was 10,000 for the current year. We will move this entire expense to the income statement. Once you have moved this to the income statement and calculated the profit or loss of the year, there's no need to maintain a balance for this. This account is zero now, right? Because you have moved the amount to the income statement and it's done. You've also calculated the profit or loss of the year. So that year is over. The expense account is over. For the next year, you will have new expense accounts and new income accounts. Okay. We have 5 elements in accounting, which are assets, liabilities, capital, income, and expenses. 2 of these are part of your income statement and they are close to zero, whereas assets, liabilities, and capital accounts are not close to zero and their balances are carried forward, because SOFP is not similar to the income statement. Income statement contains the incomes and expenses relating to the current year, where SOFP just shows a final balance of these 3 things: that how many assets do you have in your business, how many liabilities do you have, and what's the value of your capital. And then these are carried forward to the next year and they keep accumulating over time. Okay, for example, I will buy more motor vehicles in 2017, so this balance can move to 18,000, 12,000 for the motor vehicles I had, and then I purchased more motor vehicles worth 6,000, so now the balance is 18,000. So this is accumulating over time. This just shows the balance of your accounts on a specific date. Okay, that's why. I hope it's clear. Otherwise, you can always ask me questions. You can ask me in detail. If you want me to explain something in detail, just let me know. I will make a specific video for you and explain that clearly. Okay, so don't worry. That's it for this, what I wanted to cover, and then see you in the next slide or next chapter. Thank you.